കേന്ദ്ര സർക്കാരിന്റെ മുഖ്യ സാമ്പത്തിക ഉപദേഷ്ടാവ് വി അനന്ത നാഗേശ്വരൻ പ്രമുഖ വ്യവസായ മേധാവികളുമായും അസോച്ചം അംഗങ്ങളുമായും കൊച്ചിയിൽ സംവദിക്കുകയാണ്. തത്സമയ ദൃശ്യങ്ങളിലേക്ക്.
What about the inflation? Ultimately, people have to feel comfortable with the prices they pay. Now, the CPI inflation, India this time peaked at 7.8% in April-May 2022. Compared to the previous years, the overshoot compared to our target was much smaller and compared to other countries as well. We will show that slide later. But now it is coming within the RBI band of 2 to 6%. It will be heading towards 4% by the end of the current financial year. Wholesale price index is coming down because of oil price slowdown and food prices slowdown, and in fact it is now negative. Some people think when the wholesale prices come down, it may lead to a slowdown in GDP growth. Yes, this year we are expecting 6.5% GDP growth, which is lower than last year 7.2%. But that is the trend growth that India will continue to achieve. In fact, this number can be higher if export sector also performs, but that is going to be a challenge. That is why we are realistic in our expectations of what the economy can achieve. So in that sense, the wholesale price index reduction is not a drawback, not a drag on growth, but it is actually going to lower input costs for our businesses as well. And inflation expectations are coming down, which is a good news, and therefore inflation will moderate in FY24. Next slide, please. Now, we can move on. Next slide. So, what is it beyond FY23 and FY24? What are we looking at? Let's say up to FY30. The reason why we are more constructive for this decade is because businesses and banks had their problems last decade and they overcame them by repairing balance sheets. Basically, in the new millennium, there was a lot of optimism post 2002. Excess lending, excess borrowing, excess capital flows. BRICS was the rage of the world, and therefore there was a boom in India. Both investments, exports, everything, a boom in growth, boom in credit. But eventually that turned out to be unsustainable. So we know that in 2012-13, the rupee crashed, current account deficit went to 5% of GDP, and India experienced 5 consecutive years of double-digit inflation rates. And then the rest of the decade, up to 2020, turned out to be a decade of balance sheet repair in the banking system, in the non-banking system, and in the corporate sector. So basically now we have entered the third decade of the new millennium with better balance sheets, stronger balance sheets, both in the corporate sector and in the banking sector. There is willingness to lend, willingness to borrow. What you see on this slide is the debt to GDP ratio coming down in the second decade. That is what I mean by balance sheet repair. Leverage ratios came down. Now both banks and corporates are in a position to re-expand that balance sheet. And that is good news for investments, that is good news for employment and income growth as well. Next slide, please. And you see that in the bank's non-performing asset ratio, you see that in their overall capital adequacy ratio, which is double the minimum norms of 8 to 9% of risk-weighted assets. So clearly there is a better appetite and better ability to lend. Next slide. And you can see that in the credit data, growth in bank credit to agriculture, industry, services, and personal loans, all of them are growing collectively at about 16% year on year. And specifically to MSME sector, the growth rate is a sustainable 12% as well. So clearly the strength of the balance sheets is now encouraging and incentivizing the banks to expand their balance sheets, and that is beginning to happen. That's the good news. Next slide. And investment activity, we don't simply track investment activity by looking at the capital formation data, which comes only once a year. You track it by looking at the capital goods index of production in India, which is the blue bar, and then you look at the construction and machinery index production. And then on the right side, you can see that every single sector except 3 of them increase their overall capital investment in FY23. For example, the hospitality sector pre-pandemic had 4 crore employees. During the pandemic, it came down to 2.9 crore employees. Since I've been talking all along, I'm going to ask you a quiz question. What is the post-pandemic employment level in the hospitality industry? Just to give you the numbers, pre-pandemic 4 crores. During pandemic, it came down to 2.9 crores. Post-pandemic, that quickly. It's about 4.5 crores now. So basically, we have exceeded the pre-pandemic levels of employment in the hospitality industry. In fact, there are some stories in Economic Times today as well about the employment growth in the tourism and hospitality sectors as well. So basically, investments is beginning to happen in many sectors. This is on the right side. You see basically the growth rate in capital formation in FY23 compared to FY22. Next slide, please. Moving on. So how do we contribute? In fact, one of the things that governments across the country have to internalize and continue to internalize is that fiscal prudence is actually fiscal stimulus. And the reason is, the more we stick to fiscal prudence, interest rates come down. When interest rates come down, benchmark interest rates of the government borrowing comes down, interest rates in the private sector also come down. And lower interest rates is the best possible economic stimulus one can give. So in that sense, fiscal prudence is not something that is a negative for growth, it's actually a positive for growth. Okay, so that is why I think it's we adhere to the fiscal deficit reduction track of 4.5% of GDP by FY26. In fact, what is not shown in this, but in chapter 3 of the economic survey, which came out on January 31st, we have also written that primary deficit and revenue deficit came down much more sharply in the last 3-4 years in spite of the pandemic spending. And the quality of the government spending between revenue and capital has improved. 5 years ago, revenue was 88%, capital was 12% expenditure share. Today, revenue expenditure is 78%, capital expenditure is 22%, a 10 percentage point shift. So, and you can see that roughly capital expenditure directly and indirectly put together that the union government facilitates has gone up by 3x from 4.5 lakh crores to 13.7 lakh crores budgeted for this financial year. Next slide, please. And clearly, tax buoyancy helps the government do both welfare expenditure as well as capital formation. Corporate tax and personal income tax revenues are on the higher side. But more importantly, for